Well, I want to introduce everybody to our presenter today, Hratch Karakachian. And Hratch has been teaching with Cal Lutheran University for the past 7 years, 6, 7 years. And he's been mainly teaching in the financial planning program, although he's taught at Cal Lutheran and other programs and in the MBA program also. Hratch is a CPA. He has a master's of business taxation from USC. He's, as I said before, he's a CPA also. So that's some of his background. He's also a Juris Doctorate. He has a Juris Doctorate. So we're lucky to have him in our program because he can teach a lot of different classes like the estate planning class, the tax class, and any of our accounting type classes and stuff. So we've been really lucky to have him working with us. And, since what I think I read in your bio, since 2012, you've been providing legal services with an emphasis in taxation, estate planning, real estate, and business advisory services. And so that's what you do mainly, but on the side you work with us, and we're really privileged to have you working with us. So I'm going to go ahead, Hratch, and you can start your presentation on year-end taxation.
Thank you, Cindy, for that kind introduction, and welcome everyone. I'll go ahead and get started because we have a lot to cover and we don't have too much time as people start trickling in. I take it everybody can see the slides here?
I can see them fine.
Yep.
Good. Let's spend just a few seconds on the agenda. I'm going to cover some preliminary matters, then we'll get into some tax planning ideas for individuals and some separate and distinct ideas for businesses. You'll have my contact information. I'll have some Q&A session. I've only been allotted 20 minutes, and covering all of this information 20 minutes is a virtual impossibility. So I beseech you to hold your questions until the end so I can at least spend a few seconds on each subject to give you some background on this. So my preliminary matters is timing is really important. I'm very glad that all of you are here attending this. We only have about 47 days left, 46, 47 days until the end of the year. And when the year closes and the new year rolls around, it's too late to do any planning. So now's the time. And some important items, I'm sure you know a lot of this stuff, so this is a quick review for you. Accumulating the financial information for you and or your clients, if you're financial advisors. Accumulating the financial documents or assisting your clients to gather this information, and then reviewing any closed transactions or open transactions to see if they're going to be closing before the end of the year, whether you or your clients want them to close or keep them open and maybe push them in as 2020 transactions. The other item that I wanted to mention briefly is analyzing these financial transactions. It's not fun work. Someone has to dig into the numbers and prepare projections, look at the transactions, analyze them, and also keeping an eye on what's happening in 2020 or 2021 in terms of transactions that taxpayers are contemplating or could come up. The Tax Cuts and Jobs Act, I think, will be with us for the near future, unless there's a major impact and major shift in Congress next year. We could see some changes there, but for the most part, 2019 and 2020, I don't expect any changes from a tax perspective. And also coordinating all of this information with the tax advisor is very, very important. So let's get straight into the planning for individuals. The two key items here, deferring income to a future year, by either planning for something not to close in 2019 or opening a transaction in December and then waiting and not doing anything until it's formally closed in January. So what type of things would taxpayers do in terms of deferring income to a future year? Maxing out pre-retirement plans. So if clients have not maxed out their retirement plans, this is a pre-tax retirement plans. This is a good time to increase their contributions to reduce their income. Also looking into IRA contributions, even if they're members of a defined contribution or defined benefit plan, there's always an opportunity to make non-deductible contributions, and there's in certain circumstances with lower AGIs, individuals can get a deduction for some IRA contributions. Roths are very, very big, and they're gaining in popularity every day, so that's always something to look into and to consider. There's some limitations on IRA contributions, income limitations. So for those who are moderate or high income earners who do not qualify for an outright Roth contribution, there's a potential of doing a backdoor Roth, which includes opening up a traditional IRA and converting those funds into a Roth. There's some rules that need to be followed in the conversion, specifically with the backdoor Roth. So thinking about those few rules is very, very important to make sure that the backdoor Roth works smoothly. Also, Roth conversions. And Roth conversions obviously increases income because the pre-tax contributions sitting in defined contribution plans or 401k plans that are going to be converted into a Roth, the individual, the converter, if you will, has to recognize all of those funds as income. And you're probably thinking, well, why would somebody do that? Because the first bullet point here says deferring income to a future year. Well, there's some advantages. It's very, very fact and circumstances specific. So the numbers some projections have to be done. And it would make sense for certain individuals to do Roth conversions, especially if they have years where they're going to be in a lower income tax bracket, or there's an expectation that they're going to be in higher tax brackets in the future, or if you believe that the rates are going to be much higher several years down the line, which is a time period where individuals would have to withdraw or take out their distributions out of their retirement plans. Of course, with Roths, Roth owners do not have to take out distributions so long as they're alive. So there's one advantage there, allowing the Roth to grow. Keep the NIT, the net investment tax, in the back of your mind. That's the 3.8% tax that came about during the Obama administration. There's quite a large number of taxpayers, especially those earning portfolio type income, who get stung by this tax. And it's an additional tax that could be managed under certain circumstances. Qualified opportunity zones. This came out in the Tax Cuts and Jobs Act. It's in early stages. These investments allow individuals to roll over their gain from the sale of their capital gains from the sale of securities or the sale of real estate into these so-called opportunity zone investments. And that allows the taxpayer to defer and to a certain extent eliminate some of that gain. The IRS has issued some rulings and regulations clarifying some points, but there's still some information that's not clear on these investments, and there's a couple of senators asking the IRS to issue additional guidance and information. The Secure Act, which overwhelmingly passed the House this year, makes some significant changes to defined contribution plans. One of the changes is it's going to get rid of, if it passes the Senate and is signed by the President. That has not happened yet. But if it does, the Secure Act, as it passed the House, will eliminate the opportunity for individuals who inherit an IRA to be required, to be forced to take out distributions of the entire balance over a 10-year period. So if this rule passes, delaying or deferring distributions from an IRA is going to be very, very difficult to do. So if there's individuals who have trusts, either look-through trusts or accumulation trusts, as the beneficiaries of IRAs, those are the folks that should be very, very cognizant of this rule. Because if this passes, non-spouse beneficiaries will be forced to distribute the funds within a 10-year period, which is going to delay the future appreciation of funds in IRAs and these pension plans, defined contribution plans. Now let's shift over to deductions. I talked about deferring income in the previous slide, which makes sense in certain circumstances. Here we talk about accelerating deductions. In other words, taking deductions in 2019 to reduce the adjusted gross income for individuals and also their taxable income. And before the Tax Cuts and Jobs Act, a lot of people prepaid their state income taxes, they prepaid their property taxes. That planning option is pretty much gone because of the $10,000 cap. And for most people who live in high tax jurisdictions like New York, California, New Jersey, Massachusetts, are way over this 10,000 tax cap. So now the option is not to accelerate the payment of property taxes and to delay them into a future year. And the hope and the goal is to temper the cap of this $10,000 cap. Charitable contribution planning, with the increase in the itemized deductions, a lot of taxpayers are taking the standard deductions. So most of them don't have to itemize, but there's some planning that could be done with respect to the charitable contribution planning, also healthcare expenses. So if you have clients who are charitably inclined, or clients or taxpayers who are spending or will be spending large amounts on healthcare expenses, there might be some planning opportunities to prepay those expenses ahead of time to take advantage of those deductions if in total those deductions are higher than the standard deduction. Because remember, you take the higher of the two, either the standard deduction or the itemized deduction, and the itemized deductions, whichever is more beneficial to the taxpayer. So what are some of the charitable contribution planning points? The qualified charitable deduction is when an individual can direct their required minimum distribution out of an IRA to a qualified charity. The funds can't be coming to the owner of the IRA. They have to go directly to the charity, but the check can be sent to the owner of the IRA, and the owner can either deliver it or send it off to the charity. Now this point is helpful because it prevents or helps our taxpayer from not reporting the income. They don't get a tax deduction for the QCD, but then again, they don't have to report the income, which keeps their adjusted gross income low, which helps with some of the other itemized deductions. There's the bunching where individuals could contribute more in one year and less in the following year, and so on and so forth. by making higher contributions so that they can take advantage of the itemized deductions. Donor advised funds are very popular. I read something yesterday on one of the business bulletins, maybe it was Forbes or the Times, that as a result of the Tax Cuts and Jobs Act, donor advised funds donations has increased dramatically over the last year or so. Also, donation of marketable securities helps because it prevents the taxpayer from reporting any gain on sale of the securities. Hence, there'll be more bang for the buck and more funds would go to the charity and the taxpayer would end up paying less taxes. Healthcare expenses, now there's a limitation. The threshold has gone up to 10% of AGI. But if you have older taxpayers who spend substantial funds on healthcare and medical expenses, could take advantage of this, especially if they have relatively lower AGIs. Doctors, dentists, health insurance premiums, prescription medication, also caregiver salaries. Taxpayers, and I have a couple of clients in this situation who need 24 hours, 7 days a week care because they need assistance with their activities of daily living. The caregiver salaries can be deducted as medical expenses. So keep that in mind as you're working with clients and taxpayers. Another thing that employees can do before year end is to double check their tax withholdings to make sure that they have enough tax withheld. Of course, that requires doing a projection, trying to figure out where they're at with respect to their income and their tax liabilities. And there's enough information now because the October 31, 10 months of information would give individuals a good idea of where they stand for 2019 from an adjusted gross income and from a taxable income perspective. So it would be a good opportunity for individuals to run the numbers to see where they are and to see if they need to send in more and to have additional withholdings or make estimated tax payments if they prefer. Of course, employees can do both. They can submit taxes through withholdings or make estimated taxes, where self-employed individuals are required to send in their estimated tax payments via estimates, and there's no withholding opportunities. Required minimum distributions for those who are over 70 and a half is something to keep in mind. The penalties on not taking out distributions are severe, so I recommend everybody to double check, make sure that those distributions are taken. Health savings accounts, contributions. This provides a triple benefit. There's a tax deduction up front when the contribution is made. The funds grow on a tax deferred basis, and when the funds come out to pay for qualified medical expenses, they come out on a tax-free basis. This requires having a high deductible plan, and for the most part, that's reasonably easy to determine if an individual has a high deductible plan or not. And if they don't, if they do have a high deductible plan and they don't have an HSA, this is another way of creating additional deductions and reducing their income. Lost harvesting rule, even though only $3,000 of capital losses are allowed again to offset portfolio and ordinary income, this is still a good planning option. Given how the stock market has done over the last year or so, most portfolios have built-in appreciation, but if there's some positions that have built-in losses in them, one could consider selling those, but keep the wash sale rules in the back of your mind when you do that or when your clients do that. One option would be to take the wait and see approach to roll the dice, to sell the loss position and wait 31 days and then buy it back. The other thing to think about is if you have individuals or clients who have multiple accounts with different brokerages and they're trying to do some loss harvesting, you have to make sure that the other investment advisor or the other broker is not buying the same stock. And that requires reviewing the monthly statements to make sure that that hasn't happened. If all of the investments are at one financial institution, it's a little bit easier to do, but if there are multiple institutions, you have to double check that to make sure that the exact same stock has not been purchased within that 31-day window. A few additional comments regarding the estate and gift tax. The exclusion is pretty high, so there are very, very few people who will be impacted by this. And the high estate and gift tax exclusion will be with us until the end of 2025, unless Congress changes the rules. And for the last several years, $3.5 million is the amount that is the sweet spot that a lot of politicians like. It's high enough to help certain taxpayers, but it's not too high. And there's a big movement now to have to come up with a wealth tax or an estate tax to force people to pay tax on their wealth, to pay their fair share, so to speak. But let me make one point. Even if you have clients who are below this amount, it is possible, if there's a change in the law and the exclusion drops down to, let's say, the original amount, which was $5 million adjusted for inflation, that amount could be somewhere in the neighborhood of 5.5, 6, 6.5. So if nothing happens as of January 1, 2026, this 11.4, 11.58 million, these are the amounts for 2020, by the way. It's 11.4, 22.8 for 2019. These amounts, these exclusion amounts, are going to drop down to in the 5.5, 6 million neighborhood. The IRS has come out and said that if there's individuals who take advantage of these higher amounts, will not have to pay a penalty if the amounts are dropped down to lower levels at some point in the future. Excess business loss and changes to net operating losses is something that was put in place by the Tax Cuts and Jobs Act. And that limits individual taxpayers from taking advantage of their losses. The net operating loss can only shelter 80% of someone's taxable income. And the excess business loss, there's some limits where business losses cannot be used to offset all of an individual's ordinary income. So let me give you a quick example. I know I'm running out of time, so bear with me for just a few more minutes. If you have an individual who has W-2 income but has some investments, some active, is active in an S corporation or partnerships that's generating losses, before the Tax Jobs and Jobs Act, if those losses were more than the W-2 income of this specific taxpayer's taxable income would be zero, because that individual would be allowed to offset their entire income. But now under this excess business loss rule, they're limited and they will not be allowed to use their otherwise active operating losses to offset all of their income. For the high wealth folks, the annual gifting is still an option, $15,000 per year, funding 529 plans, also paying tuition for children and grandchildren tuition directly to the educational institution, and the payment of healthcare expenses directly to the medical service provider are not treated as taxable gifts, requiring the filing of a gift tax return. Insurance checkup, I have this point here just as a reference and as a reminder. It's always a good idea to at least once a year to sit down and talk with an insurance agent to go over all of the insurance policies, liability insurance, health insurance, malpractice insurance, etc. There is a California healthcare mandate now that will be effective as of January 1, 2020. The federal healthcare mandate is pretty much gone, but California and some other states, including New York and I believe New Jersey, have a state healthcare mandate now. And for those individuals who do not have healthcare insurance, there's going to be a $695 penalty or a tax charged by the franchise tax board. And this would apply to California residents and California taxpayers, obviously. There's some benefits for, they're still in place for teachers, $250 for eligible educators, which are educators in the K through 12 system. If they purchase supplies and items to be used in the classroom, they can deduct $250. There's also the education credits that are still available, but there are restrictions on the amount of income individuals have to be able to take advantage of these credits. Sometimes it's more advantageous for children to take the credits instead of the parents, but you have to look at the circumstances and see which one would benefit the taxpayer. A few comments for businesses. Just a couple of points that I talked about: deferring the income and accelerating deductions, especially for cash basis taxpayers, where if their purchases have to be made, purchase supply type purchases, those purchases could be made in November, December of 2019 and be written off as deductions against the income in 2019, so long as they're used within one tax year. Vehicle expenses require some documentation, and I personally take advantage of the vehicle expense because I keep track of my mileage and my driving, etc., and that generates a substantial tax deduction for me, and I recommend it to everybody. It's a very tedious approach to keep track of the trips, the daily trips, and the mileage. But it adds up very, very quickly if you're doing a lot of driving. $199A is the qualified business income deduction. That's came about with the Tax Cuts and Jobs Act also. It was first tax return that applied to was 2018. There's some calculations, there's some restrictions on taking advantage of the qualified business income deduction, especially with specialized service trader businesses, the SSTBs. And SSTBs are predominantly the service providers, medical professionals, doctors, lawyers, accountants, insurance professionals. For some reason, architects and engineers are not treated as SSTBs, but there are thresholds for individuals to take advantage, and these are the threshold amounts for single and married individuals. If your taxable income is higher than those amounts, then and if you're running a service business, you're not going to be able to take advantage of the qualified business income deduction. The qualified business income deduction allows a 20% deduction of your qualified business income, which reduces the tax rate from a high of 37% down to a 29.6%. And even if you don't have a service business, there's some limitations as well, W-2 limitations, and also cost basis limitations of assets used in a trade or business. So this requires some thinking and analysis as well. But there's a lot of businesses that take advantage of this. It's been helpful for a lot of businesses. The state and local tax deduction, there's a $10,000 cap for individuals, but for businesses, if you're have a rental real estate investments, property taxes are allowed 100% against that rental income. So there's no cap for businesses that incur state and local and property taxes. The other item for businesses is bonus depreciation, which is 100%. For shorter life assets, yes, exactly right, Brett. For 2019, 2020, and 2021, shorter life assets, 5, 7, 10, and 15-year property will be allowed. The taxpayers will be allowed to take 100% depreciation deduction. So for example, if you buy a computer used in your trade or business for $5,000, this rule, this bonus depreciation rule, will allow you to write off the entire $5,000 in year one, in the year it's purchased. So this will, and the goal behind this rule was to promote and help in the investments in businesses to acquire property. This does not apply to longer life real estate assets, residential real estate or commercial real estate, but it does apply to shorter life assets. It is an election, so there has to be a filing with the return for purposes of bonus depreciation. There's also the Section 179. Those limits have been increased, but since bonus depreciation is around, Section 179 will not be used because it gets you to the same place. Section 179 also allows for 100% deduction for purchases of property, shorter term property, 5, 7, and 10 and 15-year property. And this was heavily used by businesses, smaller businesses, because there were some limitations on this rule. But since bonuses is in there, most people would use the bonus depreciation rules as opposed to Section 179. Here's some background information about me and my contact info. If you, I'll stick around for a few minutes here to answer any specific questions you have, or feel free to connect with me offline. Thank you everyone for your attention, and I'm all yours starting right now. And Marcus has a question. Let's look at that for a sec. Is your physician client active in the S-Corp business? Is it unrelated to the medical practice? So the limit is 250 for single taxpayers, 500,000 for married taxpayers. If the losses from the active business cannot reduce the income by more than $500,000 for married taxpayers, married filing joint taxpayers. So for example, if your client, if we look at this fact pattern you gave me of 565 of W2, if your client has $500,000 of losses from from somewhere else, from another business, then he could reduce his taxable income down to 65. If, for example, he's got losses of 600, he can only reduce his W2 income down to 65, and the $100,000 of excess loss is not lost, but will be carried over to 2020 as a net operating loss. Did I answer your question, Marcus? By unrelated business, I meant if this was another trade or business that the individual was involved in. If you look at the example up above, Andrew, if you look at the example that Marcus posted, the 565, if this individual, this physician has a corporate, if they're incorporated and they're taking out a salary out of the corporation, then that corporation is going to have an income or a loss driven by the W2 income. Okay, so that analysis here, in that case, both the physician is not going to be able to pay themselves the 565.
Not just
Brett's question here is if the W-2s from the S-Corp, they must be going for qualified plan contributions. Perhaps, I don't know. I don't know how an individual could have a W-2 565 coming from their own S-Corp and still generate a loss in the S-Corporation. Somebody's got to be funding that S-Corp somehow. More specific question I was talking about, the excess business losses. Is the following. You have an individual who has a W-2 from their employer. Then they have another side business where their partners, the individual is a shareholder, is in an S corporation, a separate S corporation, a separate partnership with a separate trader business. And that entity is generating the loss. It also applies for individuals who have high portfolio income, where the losses will not be allowed to eliminate the portfolio income. Yeah, Brett had a comment earlier about the 75/20 discount rate regarding charitable remainder trusts and charitable lead trusts. Those are helpful, but they have some compliance. There's some compliance issues with forming a charitable trust. There's some legal fees. An attorney has to draft the documents to set one up, and there's also annual compliance costs. The trusts have to file returns on an annual basis, and those returns could get pretty complicated. Brent has another comment here. Credit cards work for cash basis taxpayers. Yes, that's correct. So if you charge something on December 31, even though you're not going to pay for it until sometime in January, you could still take it as a deduction for 2019 because the charge was made in 2019 and the credit card holder is obligated to make that, to pay for that charge. Harry has a question about homeschoolers. I'm not sure, but I don't think so. I think the K to 12 is for the supplies to be used in a at a school, at an actual physical school where there's students and there's a full-time faculty, but I'm not 100% sure. Yeah, give me a call offline, Marcus. We'll talk. Any questions? Any additional comments, questions? No, great. Well, thank you everybody for your time and attention. I'm always available. If you want to run things by me, give me a call or send me an email or connect with me through LinkedIn. Your calls are always welcome, and be happy to share my thoughts and impressions with you. Have a good afternoon, everybody, and have a productive rest of the year. Bye-bye.